kind of the house view is inflation is going to be persistently higher. And that can happen in the very short term, like literally weeks. And I think the structural forces have changed.
But the focus of our conversation isn't just any economic pundit's take on inflation. No, we're going to be delving into the mind of billionaire investor Bill Ackman. For those who don't know, Ackman is a titan in the world of investments, a man whose predictions and strategies have often accurately forecasted economic trends. Whether you're an investor yourself or simply interested in the economic landscape, his insights are something to consider.
Are you still figuring that rates at the long end, the 30-year, for example, or however on the long end, are still going to go higher?
Yes. Look, I think there's, even in the relative short term, there are a number of reasons why rates can move a lot. Among them, right, we have a government shutdown. We're going into what looks like a highly probable government shutdown. We're going to have a data shutdown, right? All these little government agencies that put out data that the Federal Reserve relies on to decide whether to, adjust interest rates, then they're going to lose access to that data. So we're going to have this sort of kind of dark period. We have probably the worst technical environment in our lifetimes for supply of bonds versus buyer bonds, right? We have China selling. We have Russia, to the extent they own any U.S. securities anymore, selling. We have Saudi Arabia selling. And we have an economy that is still strong and inflation, 3.5%, 4%. And since the financial crisis, the effort of the Federal Reserve was to make sure we didn't have deflation. And then the pandemic and, trillions of fiscal stimulus, the psychological stimulus of being free to roam after being locked up, all of these factors coming at once kind of lit inflation. And we still have this massive deficit spending. We still have infrastructure spending, and the government selling literally hundreds of billions of dollars of securities.
In the face of a changing economy, Ackman's perspective on inflation and its potential impact is invaluable. But don't worry, this isn't a dystopian prediction of financial ruin. It's an exploration of the economic landscape and a guide on how to thrive in it. We believe that knowledge is power, and by understanding the forces that shape our economy, you can make more informed decisions about your financial future. Inflation is soaring at a rate we've not witnessed in many, many years. As a cornerstone of our financial system, inflation determines the cost of living and the value of money, making its current state of volatility a significant point of concern for everyday citizens and financial experts alike. Surveying the economic landscape of June 2022, inflation reached a staggering peak of 9.1%. This is a number that many of us, even seasoned economists, haven't observed in approximately 4 decades. It's a stark reminder of a time when the economy was grappling with similar challenges, and it signals a potential shift in our financial future. But the question that's on everyone's mind is, how did we get to this point? To understand this, we need to fact-check the passage of time, the changes that have been gradually unfolding in our world. There's a whole generation accustomed to hearing about high interest rates, something that was deemed as a standard but is now a rarity. The shift has been so gradual that it's almost gone unnoticed until now. Ackman suggests that we prepare ourselves for a more drastic shift in the near future. In this evolving economic scenario, it's plausible to expect 30-year rates to break past the 5 barrier. This isn't just possible in the long term, but it's a transformation that could be seen in the coming weeks. I would not be shocked to see 30-year rates well into the 5 barrier, and that can happen in the very short term, literally weeks. To understand Ackman's perspective on inflation, let's simplify things. First, we need to grasp the basic concept of inflation. It is an economic state that happens when the demand for goods and services outstrips supply. Imagine a situation where a lot of people are wanting to buy the same product, but there's only a limited quantity available. This leads to prices going up, hence inflation. Now, let's take a look at the world through Ackman's eyes. He uses a supply and demand graph as a tool to visually illustrate his point. In this graph, 2 lines intersect, one representing supply and the other demand. When the demand line shifts to the right, indicating a surge in demand, it signifies the beginning of inflation. Ackman points out that recent economic actions have brought about this shift in the demand line. These actions include the large-scale cash injections into the economy and the lowering of interest rates by financial institutions. These measures were implemented with the aim of spurring economic activity and consumer, but they have also resulted in a significant increase in demand. Ackman continues to explain, the effort of the Federal Reserve was to make sure we didn't have deflation. In other words, the Fed sought to prevent a decrease in the general price level of goods and services, a situation that could potentially harm the economy. Finally, Ackman ties in the impact of the pandemic and trillions of dollars of fiscal stimulus into the inflation scenario. These factors, all occurring simultaneously, have contributed to the current inflationary environment. Ackman, known widely for his unique and high-performing investment strategies, has devised a plan that involves investing astutely in distinct types of companies that exhibit two essential characteristics: pricing power and an asset-light model.
You must be negative to the equity market. I mean, how could you have a positive view of stocks if you think that that's the outcome for bonds, yields?
Because if you own high quality, the key is owning businesses that have pricing power. Businesses that can do well in a world of, and by the way, many businesses can do well in a world of 3% inflation. The key is it's hard to manage a business in a world where inflation is volatile, or inflation is 8%, or the kind of crazy numbers. But many businesses can do very well in a world of 3% inflation. And the kind of companies we own, they're very much like royalties. So we own Universal Music, which is a royalty on listening to music. If there's music playing out there, Universal's getting a fraction of a penny for every song, that's being streamed. Google's a royalty, if you will, on people advertising, on the web, right? Or on YouTube. Restaurant Brands is a royalty on people eating at Burger King or any of their various concepts. Hilton is a royalty on people staying in hotels and eating and drinking and going to events. The beauty of these kinds of businesses is, actually inflation is ultimately their friend, right? As long as they can keep their costs, as long as their costs don't inflate as quickly as their revenues. And I think the nature of those, so I feel comfortable owning those kinds of businesses, even if inflation remains high. And also, again, historically, if you think about, what is the value of a business? It's the present value of the cash you can take out of it over its life, discounted back at an appropriate interest rate. We were not discounting businesses back using 2% as an appropriate rate of interest. So we've historically, our discount rate we've used, just rough measure is more like 10%, 9%, numbers which discount the uncertainty inherent of investing in equities.
Let's delve a bit into what pricing power means in this context. It refers to the ability of a company to raise and control its prices over time without experiencing a significant customer loss. Companies with strong pricing power are likely to be more resilient in an inflationary environment as they can pass on costs, thus maintaining their margins. Moving on to the second trait, an asset-light business model is one where a company has fewer physical assets. This structure enables companies to be more flexible and adaptable, which can be crucial in tumultuous economic times. They can quickly scale operations up or down depending on market conditions, thus minimizing their risk exposure. In Ackman's words, I feel comfortable owning businesses with pricing power, businesses that can do well in a world of 3% inflation. He believes these types of enterprises can weather inflationary storms better than others. Intriguingly, he asserts that the nature of these businesses is such that they can turn inflation to their advantage. Inflation is ultimately their friend. So, what companies does Ackman own? That remains a question of interest for many, especially those in the world of investments. Interestingly, it turns out that his immense $1 billion fund is not scattered across numerous ventures, but rather profoundly invested in a select few. His portfolio is intriguingly composed of only 7 companies, a surprising fact that keeps many on their toes. Each of these companies, selected with acute precision, boasts of unique characteristics, a distinctive trait that makes them stand out in the crowd. From the thriving hustle and bustle of popular restaurant chains to the powerful locomotives of modern railroads, Ackman's portfolio spans a wide spectrum. This strategic mix is a testament to his astute business acumen and the ability to foresee trends and opportunities in various industries. Each investment, carefully chosen, contributes to the overall strength and stability of his billion-dollar fund. In essence, Ackman's investment approach weaves an intriguing narrative. His portfolio, comprising different industries, aligns with the changing economic cycles. The beauty of these kinds of businesses is that inflation is ultimately their friend. Many businesses can do very well in a world of 3% inflation. Thus, these companies, under Ackman's astute leadership, not only withstand the test of time, but flourish in challenging economic conditions.